Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Another big day for earnings. Mercedes and Airbus see softness in their outlooks. We'll bring you the latest from Anglo American and Lloyds banking group and speak to the company's CEOs shortly. Asian stocks and US futures are lower as Fed minutes show a readiness to hold rates steady for longer, and President Trump's strategy for Ukraine prompts nervousness. Donald Trump steps up his attacks on Ukraine's president, calling Volodymyr Zelenskiy a dictator as the US pressures Kyiv to accept a deal to end the war.
Checking in on these markets, Anna, and the mood is pretty nervous. European futures pointing a touch higher as we digest the latest on trade, on the Ukraine war. And we have earnings, as you say, as well to look at, including out of London. So FTSE 100 futures up 0.2%, the 10-year Treasury yield at 4.5% as we consider those Fed minutes, the Fed in no hurry to move on rates. And the yen, interesting here, passing this 150 level, its strongest level in a year on the bets on BOJ hikes. The countdown to the opening trade starts right now.
Good morning. Welcome to the opening trade. It is Thursday. It has been a massive geopolitics week, of course, but at the moment, let's dive into the earnings peruse that we're seeing, because they're also starting to really take into account some of the geopolitics around the world, the tariff threat, the inflationary threat, the supply chain threat, and then, of course, the future of Ukraine, all that hanging over. But first, let's dive into details around Anglo.
Yeah, absolutely. Anglo American. So numbers here from this mining business, of course, are vulnerable to some of the geopolitical movements that you referenced there, Kriti. In terms of what we're hearing this morning, they're giving us an update on the big restructuring plans that we've seen from Anglo. They are talking about demerging their Anglo-American Platinum, or Amplats. That's expected in June, so giving us an update there in terms of the timing of the Amplats deal. They're planning to retain 19.9% interest in Amplats. So why is that the case? We'll certainly get to that part of the conversation shortly. They're also recognising an impairment. So we had expected them to take a write-down on their De Beers business, and they are recognising net impairments of $3.8 billion. The carrying value of De Beers is reduced by $2.9 billion. That's the diamond business. And of course, ever since we saw BHP make a bid for this business, Lizzy, the future shape of it and the extent to which they can take on the market's concerns, cut costs, reshape themselves to fend off that takeover activity is something that the market still thinks about.
Yes, indeed. We've also got breaking earnings out of Lloyds from London. So we have fourth quarter statutory pre-tax profit of £824 million. The estimate was for £1.03 billion, so a miss there. Interesting as well what they're saying about motor finance. Given this case with the Supreme Court, Chancellor Rachel Reeves' intervention into it, the Supreme Court throwing it out, they say that remediation costs for the fourth quarter tied to this are going to be £700 million. So this is going to be a real hole for them, given that case ongoing. But the backdrop for Lloyds, this slower than expected path of rate cuts from the Bank of England. And indeed, yesterday we had that inflation beat on UK CPI, and traders now aren't even fully pricing in 2 cuts for the rest of this year. So interesting to see how that's going to impact the outlook for Lloyds. And of course, we'll be speaking to the CEO later.
Absolutely. The trade around that, we're about 47 minutes away. Let's talk about some of the other earnings we got earlier in this morning. And a lot of it is around the concerns in the car sector. That's where I want to go next. Renault and Mercedes kind of giving the same vibe when it comes to the weakness in the auto sector. I want to start with Renault there, simply because they're talking about continuing the overhaul on their lineup to counter that EV demand story. Remember, Renault also has that stake in Nissan as well, so likely to get some comments there when we talk about it. They're also talking about pressure on their operating margin. 7% is the number that they've given for 2025. That is a drop from 7.6% last year. So you are going to see potentially that not be that well received by this market. By comparison, though, perhaps Renault's numbers coming in a bit stronger than Mercedes. Mercedes is really taking a little bit of a punch to the face here, and we've seen that in the last couple of trading days, where Mercedes has been the major mover, the major volatile stock to keep an eye on as we hear these concept of Donald Trump's tariffs, specifically on autos. Remember, 63% of its vehicles that it sells is in the United States, but they're also saying they expect their earnings to be significantly lower this year. I want to continue with the trains, planes, and automobiles.
Yeah,
theme.
shall we?
Shall
Why
we?
not? Yeah.
Why not?
Airbus.
Exactly. 820 deliveries for 2025. Far less than the estimate far less than a 2019 peak, likely to be not well received by this market.
Yeah, and they've still got all of these supplier nightmares because of COVID, which is why they can't really capitalise, make hay on Boeing's woes. But interesting, did you see this? Donald Trump says he's considering alternatives to Boeing for Air Force One, so maybe this could be lucky days.
There's an unlikely opening. Yes, absolutely. I mean, this should be a time where Airbus is able to, yes, gain market share, but as you say, still the COVID hangover holds them back. Shall we move on to talking of President Trump? Move on to the geopolitics and the incredible language coming out of the White House recently.
Yeah, Donald Trump in a Truth Social post saying that President Zelensky better move fast to reach a deal with Russia. He won't have a country left otherwise. And he calls him a modestly successful comedian and a dictator. Look, where he's got a point is that Europe does have to move fast now, and that we know that is not what Europe does well. It's not its strong suit. But where he is manifestly wrong is on just about everything else. The US does not give more than Europe when it comes to Ukraine. Zelensky's support is not in the doldrums if you're looking at the polls. And Zelensky isn't a dictator for not calling an election, or if he is, so was Winston Churchill, because he didn't do that.
Starmer making that parallel with World War II and saying, yes, we didn't have an election in this country. So there's support from number 10. It's interesting then to think about what are Trump's motivations here. Former resident of number 10, Boris Johnson, saying, stop taking him so at his word. It's all designed to shock Europe. Well, it certainly is shocking. In terms of what he's trying to do here, is this to try and get Ukraine to accept a deal with Russia? Is it actually all about money? And is it to try and get Ukraine to accept a deal that Scott Bessent, the Treasury Secretary, has been trying to get Ukraine to accept, which is around rights to future mineral extraction in Ukraine?
Absolutely, and this is also coming in the backdrop of the energy story as well. And you've heard commentary from the Russian side and Russian officials as well. Dmitry Medvedev, the kind of third president of Russia who has served under Vladimir Putin and above Vladimir Putin in that capacity, has spoken and come out quite loudly about the fact that there should be some sort of energy cooperation as well. So there is that piece of this about how much of the commodity story and the raw material story is going to factor into Donald Trump's thinking. And are the Europeans left out of it? We had a second summit in Paris with very little to show for it.
Yeah.
But the EU's top diplomat saying that joint bonds are an option, so maybe you could see developments when it comes to increasing defence spending. I want to know how you're actually going to do that, given that Ireland, Austria and Malta are meant to be militarily neutral. How are you going to get them to join in on that?
Yes, and the joint defence bonds, you know, Germany has been a holdout on that subject, so we'll watch that. We do know that Keith Kellogg, the US Special Representative, is meeting with Zelensky today, so there could be further news flow on this. And, of course, President Trump active talking about China overnight, saying there is the possibility of getting a better deal, a trade deal with China, respect for the Chinese leadership in evidence. But it's interesting to me that didn't lift sentiment all that much through the Asia session. There was much more evidence of the Fed story and the Ukraine tensions weighing on sentiment.
But on trade, the EU Trade Commissioner saying that the EU is willing to discuss tariffs. And so, to the point of reading Donald Trump's mind and trying to work out his thinking, ironically, actually, could you be seeing these tariffs leading to freer trade between the US and the EU?
We will see. We're not taking anything off the table for 2025. Let's tell you what's coming up on the programme today. It's a big earnings day in Europe, and we'll be digging into the latest reports from the CEOs of Zurich Insurance, Anglo American, Fortescue and Lloyds Banking Group. We'll also be joined by Naomi Fink from Nikko Asset Management to get a perspective on global investing. Claudia Kempfert joins us, DIW's chief energy analyst, to talk about the energy future for Germany with the election now just 3 days away.
Absolutely. In the meantime, plenty of data and numbers to keep your eye on. About 11 a.m. UK time, Walmart earnings come out. This is, of course, the United States' biggest retailer. If we're concerned about inflation, if we're concerned about spending ability, this is where it's going to show up. Then at 1:30 p.m. UK time, U.S. jobless claims as well. Before the market, we also are going to get some Alibaba earnings, already seeing some lines cross earlier from that. But then I think the real kind of highlight maybe today is going to be the Fed speak. Goolsbee, Maslin, Barr, Kugler, all going to be speaking, of course, as we just got the FOMC minutes in the last 24 hours. And I think this is crucial. You heard our very own Tom McKenzie talk about this in the last hour. A big concern around the QT of that, perhaps pausing some of that, really concerned about the liquidity, and that showed up in these numbers. But to me, I thought it was crucial that they actually talked about tariffs in this. And I really want to just highlight what they're said in the FOMC minutes, because we know that Jay Powell was, of course, Fed chair during the last iteration of the Donald Trump administration. In these Fed minutes, businesses now concerned about that tariff story. That's not really something we've seen priced in. So if we're talking about inflationary costs as a function of tariffs, the Fed is now thinking about that.
Yeah, there's been a hesitancy to put any kind of assumptions in place around that. Although I think a meeting or so ago from the Fed, we did have the acknowledgement that some Fed officials had factored some tariff assumptions into their dot plots. It does seem as if it was, at that point at least, it was very much just left up to the individual Fed officials. But so that is an interesting point, Kriti, that they're perhaps more systematically taking that into account. But back to your point around the QT, I think it is interesting that the market is, so that the Fed is drawing a link between the longer it takes Congress to get to the bottom of this, the more cash banks are going to put sort of in reserve, and that reduces the Fed's ability to sort of read the tea leaves and get signs as to how much liquidity the markets really need. And so they worry that we could see a big withdrawal of some of that liquidity that's been put on the sidelines as we get an agreement around the debt ceiling.
Ultimately, this is a little bit of a dovish take here, right? Because they're not talking about changing their interest rate positioning at all. They're also not talking about really even amping up the QT. That cut in that liquidity story ultimately is a dovish signal from the Federal Reserve. And that's something, by the way, I think we've seen kind of similar thinking around here in the Bank of England as well.
And could the extra liquidity be positive for equities? That definitely one to consider. So that's the Fed minutes. But here's what else you need to get your eye on today. In Germany, Conservative frontrunner Friedrich Merz has told Chancellor Olaf Scholz that he'll need a miracle to win the election on Sunday. Merz used the final head-to-head TV debate with Scholz to ask voters to grant him a strong mandate for a policy shift in Europe's largest economy, while Scholz accused him of overconfidence. The polls show Merz's CDU group leading with around 30% support, with the SDP trailing in third place at 16%. Elsewhere, confidence among UK households has slipped to a new low as consumers brace for higher prices. The British Retail Consortium Sentiment Monitor found that half of Britons expect the economy to worsen over the next 3 months, giving the government its worst score since it was elected. And staying in the UK, Rio Tinto is pushing back against a call from activist investor Palliser Capital to unify its dual listing into an Australian domiciled holding company, saying that tax costs would amount to billions and there's nothing to gain. Palliser has been asking Rio to end its London listing, arguing unification could unlock £28 billion of upside in the near term for shareholders, and that the current structure had cost investors close to £50 billion. Well, that story in particular interesting, given we had, of course, Glencore yesterday saying that it's considering, or we reported that Glencore is considering dropping its London listing. I wonder whether this is something that's on the minds of Anglo-American as well.
Yeah, nothing so far in the release that I can see on that particular subject. But it is interesting, the different decisions that these businesses are making. So Rio, interesting that Rio's, according to our story, the Rio shareholder register is much more London-focused, London-weighted than the BHP one was back in 2022 when BHP made this decision to unify their listing. So it's possible different mining businesses, based on the domicile of their shareholder base, might make different decisions here. But yeah, interesting to see that Rio is rejecting something that Glencore is considering.
Absolutely. And it's coming at a time when we've talked about in the Glencore as well, talked about buybacks, talked about increasing the dividends. Rio Tinto working in the exact opposite direction to pull back from that kind of shareholder return. That might hurt the stock as well this morning.
Interesting as well, because the Rio CEO delivered those results in Washington, so clearly trying to get a feel of the Trump administration and actually putting a positive spin on it, saying that there could be some opportunities out of all of the trade policy at the moment. OK, coming up on the programme, we'll stick with the earnings stories. One of our core 6 stocks at the open, Schneider Electric, posts a profit beat. We'll check on the shares at the start of trade. Plus, Fed minutes signal a hold on rates until inflation improves, adding to a cautious mood in markets. Up next, we're joined by the head of Zurich Insurance, who will update us on his company's exposure to the Los Angeles wildfires. If you have any questions, if you want to get in touch with us, IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
We're about 40 minutes away from the opening trade. Take a look at futures. Green on the screen across the board. The Stocks Europe 600 higher by about 0.3% in that futures picture. I think the outperformer there continues to be the outperformer of late, and that is DAX. The DAX. You are seeing futures there higher by about 0.4%. Do we start to see some of these earnings stories, though, change a little bit of the picture? It is earnings palooza. We are drinking, or I should say drinking straight out of the fire hose this morning. Let's talk a little bit about one of those numbers. Airbus here, we want to issue a little bit of a correction. The delivery numbers did come in at about 820 deliveries. Our estimate, we had previously said, was about 839. I'd like to correct that. The estimate was 823. Airbus still falling short of that estimate, really looking at the likes of supply chains, trade concerns, and, of course, far below its peak in 2019. We'll see how the market digests that at the open, Anna.
Yeah, let's get to some of the other earnings stories we've had out this morning. Zurich Insurance has reported full-year operating profit that beat analyst estimates. The Swiss insurer sees a pre-tax impact of $200 million from the California wildfires. We're joined now by Mario Greco, the CEO of Zurich Insurance. Mario, nice to have you on the programme. Thank you so much for coming to be with us. So the numbers look to be better than the market had anticipated by a little. You do tell us that the California wildfires have a pre-tax impact of $200 million. And I think this is perhaps concentrating in the farmers' part of the business, where I think you had some exposure. Mario, can you tell us a bit about how the business has managed that particular risk?
Absolutely. Good morning. So Zurich Insurance does not insure private customers in the U.S., and consequently, the only exposure we have as Zurich Insurance is for the commercial business. And this explains why then the impact on our P&L is expected to be the one we mentioned. Farmers, however, our control company in California, does insure private customers across the U.S. and, of course, in California. And so they issued a press release a couple of days ago where they indicated that the net losses that they expect will be around $600 million. Because of the reinsurance structure that they have. Of course, the gross losses are much higher. Our commitment as Zurich and as Farmers is to fix as quickly as possible our duties with the customers, help them rebuild, help them restart, and make them in the conditions to go over this terrible tragedy that happened there.
Yes, and just to linger on this subject a moment longer, Mario, I know that you previously suggested that in the rebuild, perhaps the structure of the city or the way it's protected from fire risks, the way it's defended from fire needs to change. In the conversation that has followed the fires, Mario, do you see any evidence of any change in the way that it is going to be rebuilt?
I think it's early to say. At the moment, it's really just about taking away the wreckages and the remainings of the damages. It's too early to really understand. I think prevention will be the next very important decision to be made there. Wildfires happen, not just in California, and we all need to be aware of these risks and prevent it, because that is what we have to do. We need to avoid these things to happen. And as Zurich, we feel that it's our role to help preventing.
Well, on the climate theme, Mario, you've welcomed Donald Trump calling for the US to quit the Paris Agreement. Does the world need to have a complete rethink of the way that it approaches climate change?
I think we need to rethink. The climate is changing rapidly, or has changed already. That makes prevention a priority at this moment. Adaptation to this world is a priority at the moment. The other thing is that we need to rediscuss how we produce, or how we will produce energy. We need energy. The idea that we can live in a world with less energy availability is not a serious one. And we need to discuss how is the energy going to be produced and what's the impact of that on the planet. So I think that the opening to a new way of thinking about it, it's welcome.
And it's certainly something we'll be thinking about in the context of Germany, which brings me to Europe, Mario. The Danish compromise gives banks in some EU countries a capital advantage when they're buying insurers. And this is unlike standalone insurers like Zurich Insurance. So I wonder, are you frustrated by this uneven playing field that's been created?
I just don't understand logically why this is ruled like this. The Danish compromise originally was a quick fixing and it was temporary, and it was meant to be like that. Now has become permanent, and with all the history that the banks have on their capital solidity, I don't quite understand why they're allowed to buy at a cheap discount businesses that for others will be more expensive, and why there is such an asymmetry. I think it's a very curious development, and one that I fail to understand that has a logic behind.
Well, Mario, we of course know that regulation in different parts of EU countries is certainly starting to show cracks in terms of the way the system functions. Just one of a laundry list of issues and risks around the world, especially that geopolitical volatility. For an insurer, though, is that a positive? And what is your biggest kind of risk these days? How are you viewing the world?
The world is definitely full of risks, which is also our activity to protect customers from these risks. The biggest risk that we see today, specifically to our customers, is the increased probability of having accidents hitting their properties because of weather-related events. And this is where we're very active, trying to help them avoiding this. More and more, we feel that our job is to avoid that the things happen more than paying for the damages. And so we have created units which specifically help customers in doing assessment of the risks and then in finding actions that will minimize the impact if something happens to them.
Well, Mario, when we talk to some of your peers, they're looking at things like cybersecurity. They're looking at geopolitical risk, specifically in Eastern Europe as well. How are you thinking about that, especially at a time when so many other insurers around the world, especially in the United States as well, are already kind of adjusting their approach to their exposure in the United States, which we had previously discussed, but also their exposure to some of the more perhaps geopolitically volatile regions? How are you thinking about that exposure and how it affects your strategic focus?
I find it very difficult to discuss geopolitical risks because, of course, it's a fascinating topic, but it's highly debatable what's going to happen in the future, and it's highly dependent on a lot of circumstances that will need to be confirmed in the actions. So although it is there, and although we consider it, we don't have a precise scenario. Cyber is a different thing. Again, it's about prevention. You can protect yourself and you can invest in protection. As always, with every kind of risk, no protection is proofless. I mean, and you will always have a margin of risk remaining after that. But we're very active with the customers in helping them building fences, defenses, walls against the cyber risks.
Mario, Greco, we'll have to leave the conversation there. We thank you so much for your time this morning. CEO over at Zurich Insurance joining us this morning. Coming up on the program, Fed Minutes show policymakers are discussing pausing or slowing the balance sheet runoff. We're going to dive into the details next. This is Bloomberg.
Welcome back to the programme. This is the opening trade. It is Thursday, the 20th of February. In terms of the futures picture, then, this is what we have for Europe. Expecting to go actually a little bit higher at the start of the European trading day. Futures pointing up by 0.4%. We've had plenty of corporate reporting out this morning. Not all of it has delivered positivity, but perhaps there are areas of that. US futures pointing lower, down by 0.4% on Nasdaq futures. E-minis down 0.3 this morning. In terms of the bond market story, we'll get an update on what's been going on treasuries in just a moment, because there's a lot of interest there in the Fed narrative. But for what it's worth, this is the European picture, as we continue to be a little bit concerned, or have been for the last few days, about increasing fiscal spending to equip Europe on defence. Let's pivot to the Fed conversation. Fed minutes showed that officials expressed readiness to hold US rates steady until they see more progress on inflation. Let's bring in Bloomberg's Valerie Teitel, who's been poring over the details of those Fed minutes for us. Val.
Anna, the big takeaway is that these minutes did suggest that the Fed is on an extended pause until we see more progress on inflation. But there was some devil in the details here, especially some interesting comments when it comes to quantitative tightening. There was some suggestion about a discussion in either pausing or slowing down quantitative tightening around the debt ceiling showdown yet to come. Now, this is very interesting, Anna. It's the first time they've mentioned something that directly around the path of quantitative tightening going forward. And they also could be suggesting that they are maybe concerned about the low level of reserves in the financial system. So this is maybe the first hint that a pause to quantitative tightening is on the cards. We saw Treasury yields a decline on this. Treasury prices really did like it. We also saw a pop in S&P 500 futures as it adds more liquidity to the banking system and to the financial system generally when they do pull back on quantitative tightening. So a very interesting development to keep our eye on there. Another thing to keep your eye on, Anna, is what's going on in Japan. The yen woke up on the right side of the bed this morning, having a great session, down 0.9% on dollar yen, the yen strengthening versus the U.S. dollar. A lot of this is around the narrative of the rise in JGB yields. We've seen a sustained rise in not only front-end yields, but longer-term yields as the market adjusts to the Bank of Japan leaving the lower bound. It was also interesting that traders noted that the Bank of Japan met with the government officials, and there was no discussion about any concern about the rise in JGB yields of recently. And we're seeing that as the green light for the Bank of Japan to continue their tightening cycle.
You know, Val, it's fascinating that we're talking about a tightening cycle with the Bank of Japan when we're also talking about potentially higher energy costs as well. We know Japan is one of the world's largest importers. How does that square with what the market is forecasting?
Look, we're around 80% price for another Bank of Japan hike come July. But note, Kriti, there has been a string of both great economic data and softer data on inflation. And that combination is really letting us to believe that before the Bank of Japan tells us we're going to go ahead and price in further rate rises. We do also have a Japanese CPI out tomorrow morning. That could be another kicker to this narrative. So watch how the yen performs off the back of that.
Yeah, and Valerie, interesting that the yen is gaining then. And you set out the JGB and Bank of Japan reasons why we might be seeing that. The other side of that is the dollar weakness. It's interesting to think about where we are in global risk appetite right now, because on the one hand, we do seem to, we've had some lines out of President Trump talking about the possibility of doing a deal with China on trade. But the markets, and certainly the Asia session, seem to be more preoccupied by the latest news lines on Ukraine and what they signal for global risk.
Yeah, it was quite head-scratching, actually. We not only had that comment from Trump about a potential trade deal on China, but also EU officials saying they want to cut a deal with Trump as well. They want to lower their own tariff rates, even mentioning the car industry directly. So it seems like there has been a bit of de-escalation of the trade tensions. It's not really been reflected in the Asia session overnight, nor in S&P 500 futures. Here in Europe, we did see, futures react positively to that, but a lot of that could be rebounding from such a massive slide yesterday. A big theme of yesterday's session was that European equity rally finally lost some steam. One of the worst days for European equities since early December.
Bloomberg's Valerie Teitel walking us through the dynamics at play in all of these markets and a little bit of a tour around the world in that central banking strategy. Let's dive deeper into what she was just talking about. Naomi Fink, Chief Global Strategist over at Nikko Asset Management, joins us this morning. Naomi, a pleasure to have you on the program. We were just talking to our markets reporter there about how you actually square some of these tariff threats with the concern that it could actually lead to inflation at a time when it doesn't really feel like the markets are pricing in anything super hawkish. How are you thinking about that in the context of the Fed minutes we got in the last 24 hours?
Well, the Fed does remain on a normalization cycle. And for the Fed, in contrast to the BOJ, normalization does mean rate cuts. Of course, for the Fed to continue cutting rates, then you have to see continued progress on inflation. And I think what we saw from the recent minutes was that the Fed hadn't seen enough progress on inflation to continue cutting at this moment. But the bias remains. So I think if we do get softer readings, then the Fed would be inclined to continue cutting. And if we do, conversely, see inflation still stay uncomfortably high or even head higher, then of course that would be a different implication for interest rates. But as you said, people aren't really pricing in any type of disaster scenario right now. So my hypothesis is that, yes, we might see rates and inflation stay a bit higher than we did in the pre-pandemic era. So the trough in interest rates is going to be higher, I think, than in the pre-pandemic era. That said, we aren't seeing anything really break down at the moment. The U.S. economy is doing relatively well and still isn't experiencing extremely high inflation. Yes, the tariffs are a worry and they can contribute to inflation, but they do also contribute with a lag. So it's not something we'll see immediately.
We won't see it immediately, but I almost wonder if maybe the liquidity in the system almost protects from any sort of panic or pricing that we saw, at least in the first Trump administration as well, pre-pandemic, as you add. Naomi, there's a concern in this market that the gains that we've seen in the last, I want to say, 4 or 5 years since the COVID pandemic has really been a function of liquidity, a.k.a. more liquidity from the Federal Reserve equals stock market increases. Is that still the Achilles heel of this market, that if we see less liquidity, that's where the market drops?
Well, there are some studies that have taken the declines in interest rates and in tax rates over an even longer period, 30 years more, and said that these have really contributed a large amount to corporate earnings. And it's kind of mechanical. You can see it on the corporate earnings. So that's really hard to deny. So the question in my mind is not whether this is true or not, and also and not even whether we're likely to see less stimulus going forward than we did most recently, which I do think is likely. But now it's whether those huge investments that have been made in the United States are likely to pay off, because we haven't seen broader total factor productivity increase. And in my mind, that means opportunity. It has yet to happen. So there are firms that stand to benefit from adoption of these new technologies.
Yeah, certainly the productivity story could get really interesting from here, Naomi, on a number of fronts. Let me ask you about tariffs and what is priced into global markets, do you think, in terms of tariffs? Because it's interesting this morning seeing the forecast coming through from Mercedes saying that they are the 2025 targets don't include potential tariffs. They could potentially cut 100 basis points from margins. Airbus, another business, also not including any kind of tariff threat in its outlook. It might be too difficult for businesses to do that because details are too sketchy. But how are you thinking about what is priced in and what is not on the tariff front?
So from what I can observe, I think the pricing of the tariffs, much like the messaging, just changes from day to day. Although markets are probably relatively certain that something is going to happen. We're still a few weeks months into this administration in the U.S., not exactly sure how it's going to pan out in the end. So I think some caution over inflation that's priced into the market is merited. Is a full disaster scenario hyperinflation merited? Probably not. It would not really be rational for the U.S. to pursue that type of extreme policy. So maybe there's a lot of talk going on, but we might see policy be a lot more reasonable than some of the radical talk that we hear.
Yeah, you kind of wonder what's worse, the tariffs themselves or the uncertainty around them. Morning, Naomi. It's Lizzy here in London. I just want to pick up on China, given your perspective there in Asia. We've had lots of optimism of late on China tech after DeepSeek. Jack Ma, of course, meeting President Xi, Goldman uprating the MSCI China. But we've had some input, shall we say, from Robert Lee here at Bloomberg saying it's all hype. There isn't going to be an earnings renaissance. At best, the China tech earnings outlook's mostly unchanged. I wonder where you stand on that. Who's right?
Well, in my mind, we had a really bearish scenario priced in for China until recently. If we look at global valuations, then we had, even if they weren't ultra cheap, they were a lot more reasonable than valuations in other markets, such as the US. And you heard a lot of ultra bearish messaging there too, like China being uninvestable. So probably in reality, we're somewhere in between China being uninvestable and a massive boom story. I think what's happening right now is that those ultra bearish views are being priced out, which is probably right. And we're a little bit in wait and see mode as well, because well, what is the government going to do? Are we actually going to see meaningful stimulus that's aimed at consumers as well? If so, that could be a double support here. We have the technology and the potential for demand abroad, even despite the tariffs, but then a domestic demand story. That would be a lot more positive than what we see now.
Yeah, another bit of uncertainty to factor in for these markets. Naomi Fink, really good to talk to you this morning. Chief Global Strategist over at Nikko Asset Management. We thank you. Now coming up, Airbus striking a cautious note for this year with a delivery target just lower than estimates. It's one of today's stocks to watch, and we'll bring you those next. This is Bloomberg. 3 days to go until the German election, and the Conservative frontrunner Friedrich Merz has told Chancellor Olaf Scholz that he's going to need a miracle if he is to win on Sunday. Merz used the final head-to-head TV debate with Scholz to ask voters to grant him a strong mandate for a policy shift in Europe's largest economy.
In den nächsten 4 Jahren.
We have to solve two major problems in this country over the next 4 years. That is migration, and it is the economy. And if we don't solve these two problems, then you and we and all democratic parties in the political center will not be facing a mere change of government in the 2029 federal elections, but rather we will slide into right-wing populism for good.
Zu vermeiden. Und deswegen ist die Antwort sehr klar.
I am convinced that this time there will be something that has rarely happened to this extent in previous elections, namely that some people will go into the election, into the polling booth, and only then decide who and which party to vote for. And I believe that in the end, many people will vote for the SPD and give me a new mandate to lead the next government.
Bloomberg's Oliver Crook in Berlin stayed up to watch it so that you didn't have to. Let's bring him in now. Ollie, what stood out to you from the debate?
Yeah, so listen, I think that overall, Lizzy, I kind of agree with the first part of Olaf Scholz's reflection there. I'm not sure if I agree with the second part of it. What he said there basically was that many people on Sunday will go into the voting booth not knowing who they're going to vote for and really make the final decision while they're there in the voting booth. He thinks, the second part of the statement, that that means that'll be more votes for the SPD. That is the part I'm very skeptical of. But going into this weekend, thinking about the setup going into the vote on Sunday, February the 23rd, we have seen polls that have been basically unchanged since this election campaign kicked off. Basically, it seems anything any of the candidates have done very little to move the dial. But I think there's a huge proportion. Again, you see this in some of the data, in some of the polling that we've heard out of Germany, that there are a lot of undecided. But when you talk to people, again, anecdotally, there's a huge proportion of the people that I talk to that really don't know who they're going to vote for on Sunday. Now, that could cut a lot of different ways. We should also add the fact that with the AfD in the second spot here, that's the first time we've had a far-right party anywhere close to number one spot since the end of the Second World War. Could there be a sort of phenomenon that we saw in the first Trump election campaign back in 2016, where a lot of people were wouldn't talk about voting for him? There was a sort of taboo around that. Could you see that boost the AfD's numbers a little bit? And could you, on the other side, see the CDU numbers come down a little bit because people are not necessarily convinced by Friedrich Merz? And again, these are the sort of unknowns going into this election. I think that often in the German political spectrum, you have a little bit more certainty going into the election. So I think you could get a bit of a surprise on Sunday. Again, we'll have to see how that pans out on Sunday night at 6 p.m.
Ollie, talk us through kind of the auto industry readout here as well, because you talked about Trump, you talked about this plan from the German politicians as well. At the end of the day, how is this all going to help with the auto industry, especially in the context of the lines we got out of Mercedes this morning?
Yeah, listen, Kriti, I think it's worth going through some of those lines out of Mercedes because, again, it was a very sort of poor quarter and really a poor full year for Mercedes-Benz. Again, looking at revenue, that came down 5%, EBIT down 30%, net profit down 30%, free cash flow down 20%, earnings per share down 25%. We should say that within some of these numbers, there were some beats to analyst estimates, so this is obviously a bad year-on-year comp. There were some beats, for example, their return on sales, the margin margin came in at 8.1%. That beat the estimate of 7.4%. But overall, the other thing that we're seeing at Mercedes-Benz, and something that we saw from some of the other car makers in Germany, is now a performance plan. They want to cut costs by 10% across the board over the next few years. You could probably read into that the potential of job cuts. They really need to bring that cost base down to get those margins back up. And when you look at the outlook, Kriti, this is what I'll leave you with here as well. Revenue is going to fall again this year, a second consecutive year for Mercedes-Benz. We should say that also their EBIT, they expect it to be significantly below the previous year's results. And again, looking at their sort of margin targets for this year, it's now between 6% and 8%. That'll be down presumably from about the 8.1% that they got. And again, Kriti, there is another question in the air here, which is what are any of these outlooks from the car companies worth going into 2025 with the unknown of 25% tariffs from the United States hanging over them? That is really the big question. So listen, the outlook is there. Whether or not it's worth anything, we'll have to see on April 1st when we expect to get those tariffs from the United States.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Oliver Crook walking us through that Germany story. We thank you so much. We're going to bring you all the news, analysis, and market moves as we continue to build up to the German elections, including a special program when polls close on February 23rd. That happening live from Berlin this weekend.
Yeah, absolutely. So we continue absolutely to build toward that election on Sunday. Let's talk about where we are on global markets, though, because there's a lot happening. We're joined now by our Markets Live executive editor, Mark Cudmore, to talk us through his latest thoughts. And Mark, it's interesting to think about the strong dollar theme, which was such a feature of President Trump's election, and yet we haven't, since the middle of January, actually haven't seen another top in the Bloomberg dollar index. So there has been some weakening in that dollar. On top of that, you see some strength in the yen. I wonder your latest thoughts on how resilient the dollar can be.
I don't think it can be resilient at all. I think 2025 is the year of bearish dollar. And I think what's interesting is that everyone is fighting the dollar weakness at the moment. You mentioned that overnight, the latest round of dollar weakness was led by some hawkish comments out of Japan's, therefore the yen leading that. We also had some strong Australian data. We had Trump mention the idea of a Chinese deal, which helped the yuan. So there are several currencies kind of playing the part today. But what's interesting at the moment is everyone is fighting this dollar weakness. Everyone is talking about how the dollar will rally once again just when tariffs come back into play. It sounds logical, but I worry how consensus it is. And we're just talking about the German elections there. Everyone is saying that the German election result will be bad, and that's another reason for why euro-dollar will dip down towards parity. I think there's a high risk this weekend that we might get a supposedly negative result from the German election, and yet euro-dollar doesn't suffer much because everyone is too positioned for it. So maybe we get a knee-jerk move lower, but it very quickly bounces because the whole world's already expecting that move. And the asymmetric risk-reward is for euro-dollar to, in fact, go a bunch higher.
So that's the currency picture. Mark, when you're looking at the Fed minutes, Val has highlighted that actually what they were talking about in terms of QT is perhaps more interesting than what they were saying about the rate path. How significant would it be if they do slow or pause QT in your view?
I do think it was more relevant, but partially because the minutes otherwise on policy are completely pointless. We have so much uncertainty about what the administration is going to do policy-wise that we can't. The Fed can't really give any guidance. So, you know, that they have to wait and see what Trump delivers on policy and what that means to the inflation path. So the rest of the minutes had no value, which means, yes, the QT argument was a little bit more valuable. I think that does matter at the margin, and that kind of helped kind of yields not kind of interpret a hawkish message from the minutes. But I still think we have to wait and see how that plays out. It ties in with everything, and essentially we're waiting to see what Trump delivers on tariffs and trade policy.
So, Mark, very quickly, if Trump does deliver on those tariffs and trade policy by April 2nd, does that put hikes on the table this year?
I don't know, because the impulse will be a stagflationary impulse. Last time, it was much more of a negative growth impulse than inflation. But that's because we'd had decades of not really an inflation threat. Now we're coming out of an environment where the world is worried about inflation. So I think that the inflationary reaction function will be quicker this time, which means it's a stagflationary impulse. Now, the impulse word there is important. It doesn't mean we get stagflation. It just means it hurts growth and it adds to the inflation picture. What does that ultimately mean for Fed policy? Unclear, but I think the growth impact's more important.
Certainly something we're going to be keeping a very close eye on. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You can get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So Schneider Electric's report looking pretty strong on both the sales and the margins. And bear in mind, this company was hit a couple of weeks ago by the DeepSeek sell-off as people questioned whether that could change the outlook for data centres and AI. So potentially this could be a strong one today. Then in terms of Airbus, the key line on that seems to be a disappointing dividend. That was in a note from Jefferies this morning. That could potentially threaten the outperformance we've seen versus Boeing over the past year, something that's continued for a couple of years. In fact, there's a lot of buy ratings on Airbus as well, more than 20 positive ratings. So potentially they might be a little bit disappointed this morning. Then in terms of miners, a couple of weak ones out of Australia. Rio Tinto, that one was lower on a disappointing outlet for its metals demand, mostly linked to China. And we also saw a bit of a similar report coming out of Anglo American. Now, this stock has actually given up a lot of the gains it saw last year when BHP was said to be interested in the firm. So keep an eye on that one as well. Then in analyst ratings, UBS downgraded at Morgan Stanley this morning. That one should be weaker in Zurich. And we've also got some changes to the oil ratings at JP Morgan, including a downgrade for BP. Keep an eye on that one in London today.
Joe, thank you very much. Joe Easton there from our equities team with a lot to focus on this morning. We've had corporate earnings aplenty. We'll also keep an eye on Carrefour, on Schneider Electric, Mercedes in focus, Renault in focus, the car sector firmly in the crosshairs this morning. We will continue to monitor all of those as we get into the start of trade, and we'll continue our focus on the mining sector as well with some important conversations in the next hour. This is Bloomberg. A few minutes to go until the opening trade for this Thursday morning. Let's have a look at the handover from yesterday. And this is the kind of storyline that this chart was invented for, I suppose, because yesterday we saw European stocks very much on the back foot. That's the white line here. That was followed by a US session that was more on the front foot. And so as a result of that, you would expect there to be a natural sort of urge to go higher at the start of trade. And we'll have a look at the futures in just a moment. But yesterday really did mark an important point. We were down by more than 1% on the Stoxx 50 by the close. A lot of people asking questions about whether what we've seen year to date, the outperformance from Europe, from other parts of the world, in fact, versus the United States, whether that really can continue. And then US stocks gaining, of course. You have to wonder, then, Kriti, whether the geopolitics, whether the Fed expectations, whether they weigh on that at all, or actually this just tells us what we need to know.
Yeah, buy into the open, sell into the close. That seems to be the mantra in the last few weeks when it comes to those European equity pictures. You're seeing that exact story here this morning as well, Lizzy. Euro Stoxx 50 futures pointing higher by 0.3%. But again, deja vu here. The DAX is the outperformer, higher by 0.5% in the futures picture. We'll see if it shows up at the open.
In terms of some of the stocks we're watching as well this morning, lots of earnings to factor in. Airbus setting a pretty modest delivery goal amid all of this continued supply snagging. We have Schneider Electric hit by the DeepSeek sell-off and yet beating estimates on profit and revenue. Mercedes, as Ollie says, outlining cost cuts, but how much of that is already priced in? Could be miserable as well for the miners off their earnings and all that tariff uncertainty. We have Rio and Anglo to keep an eye on, and lots of big names ex-dividend today, not least Astra, BP, EasyJet and GSK, Anna.
Yeah, absolutely. A very timely reminder to keep an eye on those. So we'll see how the earnings stories manage to cut through the macro picture, if you like, around China, around the Fed, around the concerns geopolitically for Ukraine. Let's have a look at the opening trade then. The FTSE 100 out of the gates and down just a touch at the start of trade. We've got some big corporate reporting there. We've also got some ex-dividends to keep in mind, as Lizzy, you were mentioning. So the FTSE 100 is opening up. We don't see any movement on any of the other markets just yet. There we go. The Stoxx 600 down by 0.1% or so. So contrary to the expectations at the start, so far, the direction of travel has been a negative one. We did have that positive handover, if you like, from the United States. But then you layer on top of that some of the outlook statements coming out of European corporates, the likes of Airbus, the likes of Mercedes, and that didn't feel very risk-on. But the picture then a little more nuanced. So we're waiting for the CAC and the DAX to open. Perhaps they'll take some time. We've got a lot of corporate reports coming through from those particular geographies. But we are looking then for the numbers out of the car sector, Renault, Mercedes, all in focus. The aviation sector with the numbers out of Airbus, of course, as well. And so with that in mind, Kriti, taking a little while to get some of these sectors open.
Absolutely. But when you are looking at what we like to call, guys, core six or sensational six, not really being very sensational this morning. I'm looking at Novo Nordisk, I'm looking at ASML, and I'm looking, of course, at some of the kind of bigger energy names here, all on the back foot. So when we look at that kind of breakdown, BP, for example, already taking a beating this morning, down about 1.2% as well.
That's an ex-dividend, isn't it, as well?
That's certainly one as well. But then you're seeing in the other energy stocks as well. So Shell, Total, even Rio Tinto taking a beating, and we talked about those numbers earlier as well. The upside, though, Zurich Insurance, which I think is an interesting one.
Yeah, I saw a note from an analyst earlier saying that the company is reassuringly reliable. These results coming in pretty much, if not a little bit better than analysts had expected. So Zurich Insurance at 1.6 today. We'll be speaking to the CEO. We've spoken to the CEO, deja vu again. But if we break down the sectoral basket, we've got about 3/4 in positive territory. Telecoms leading the gains, higher 0.4%. Bottom of the basket, though, energy down about 0.5%. And just coming back to some of those other earnings out this morning, zooming in on Anglo American, those shares now at 1.8%. Joe had said, they'd given up a lot of last year's gains since BHP was looking at them, but actually now 2.1% up. So a pretty good morning off the back of those numbers this morning.
It's really interesting. The mining sector, we are seeing a cut through from some of the earnings stories. As you say, Anglo American is one of those that goes higher today. Interesting that Rio Tinto is down by 0.9%. Is that anything to do with the fundamental news flow, or is that all around the business and the fact that they've rejected the idea of unifying their shareholder structure into the Australian listing? That would have been an echo of what we've seen from BHP, but the inputs to that conversation look different, and they've urged shareholders to vote against one particular shareholder who's been wanting to push for that. So that's interesting to see that Rio stands out to the downside this morning.
Absolutely, and also standing out in the fact that in the last couple of days we've got some major kind of bids into the idea of shareholder returns. We also know that the mining sector is one that is extremely exposed to the China story as well. So when we see the optimism around China kind of come back to the forefront, it's going to be reflecting those mining stocks, perhaps that feeding into the broader sentiment, Rio Tinto aside.
Yeah, really interesting to see that construction. It's quite a volatile morning, isn't it?
Yeah.
We do have the DAX open, actually. It's up by 0.3% then now. So we do see some upside. The stock 600 then flat now. As we saw the FTSE open, and it's down by 0.3%, it seemed as if the expectation that we go higher at the start of European trades looked a little flawed. But actually now we've got the DAX open and we do see some positivity. The CAC still to open. But interesting that construction and materials is one of the best performing sectors today for European equity markets, actually now replaced by real estate. So quite a volatile sector actually this morning, taking a while for investors to get their trades in perhaps this morning.
We should mention very quickly that Schneider Electric is also moving. It did report earnings this morning. Their revenue did come in better than estimates as well. But when you look at the earnings picture, shares moving higher by about 6%. It was originally halted. It has now kind of resumed some of that reaction. So we're going to check on the core 6 a little bit later and see if it shows up.
OK, let's get to the corporate reporting then this morning. Anglo American has reported numbers. The stock is up by 2.2% in this morning's session. It posted a slide in profit, joining its major peers as the miner moves ahead with a radical overhaul of the business. The company also took another write-down on its De Beers diamond unit. Joining us now is Duncan Wanblad, the CEO of Anglo American. Very nice to speak to you, Duncan. Thank you for joining us once again this morning. I wonder your overall message to markets this morning then, as we sit here looking at your stock is going higher. There have been a number of announcements. The write-down is one of them. You're busy with a really quite radical overhaul of the business. What is the overriding message to markets?
Well, I guess the real message is we're getting on with it and getting it done. I mean, we announced in May of last year an acceleration of our strategy, and that included a major transformation of the asset base, which really was led by 4 major demergers or divestments. We're pretty much on track with all of them. Got to the point where we've announced 3. The last one to happen is going to be De Beers, and things are going well.
Things are going well, you say there, but just in terms of De Beers, what you've announced this morning, you've reduced the carrying value of De Beers by $2.9 billion. What visibility do you have on whether that is it for that particular process around De Beers?
Yeah, impairments are very technical. I mean, I guess they very much are a function of the calculations that you run on the forward look of the business relative to prices, volumes. In De Beers' case, this was particularly impacted by the permanent scarring that we believe has happened to the industry at large as a result of lab-grown diamonds. But it in no ways refers to the quality of the business, the underlying nature of the assets, and the future viability of this business on a go-forward basis.
OK, that on De Beers. Good morning, Duncan. Thanks for joining us. Lizzy here. As I look around your sector, we have Glencore looking at abandoning its London listing. We have Rio under pressure to focus on Australia. BHP already doing that. I'm sure Donald Trump would welcome you with open arms, but please tell us you're not thinking about leaving London.
We're not thinking about leaving London at all at this particular point in time. No, we're very focused on delivering the strategy that we've got today. London works absolutely well for us, and we're pretty focused, on getting this done. So not having to worry or think about new jurisdictions for listing the company at right now.
But why do you think everybody else is jumping ship or thinking about it?
Look, I'm not really sure why everybody else would want to do it. What I care about is what works for us. London's a good place. It's served us well since 1999. We can do everything that we need to do. Most of our shareholders are in and around London, and we have very good access to the market. So, there's no reason for us to be looking at changing our listing or our jurisdiction at this point.
Duncan, it's Kriti in London. You talked a little bit about your listing of the broader company. I want to circle back to the listing of De Beers as well. An idea that has been floated around that business, just following up on Anna's question there, is a potential IPO of De Beers or even a trade sale. Are any of those on the table?
Yes, no, definitely. Both of those are on the table. We are running a dual-track process, so the possibility of a trade sale and at the same time the development of a prospectus for the possibility of either a demerger or an IPO. I think markets have to be in a condition to accept an IPO. To the extent that that's happening, it's going to likely be more towards the end of this year than the beginning of this year. But a trade sale could happen anywhere between now and then.
So you said you're doing a dual track there. Is one more likely than the other, given the kind of time frame dispersion that you just outlined?
I think a trade sale is more likely in the short run than an IPO.
In terms of that IPO as well, I mean, I want to ask you about what that signal may actually look like. You're talking about the end of the year. What is that kind of green flag for you in the market? What does that look like at a time, by the way, when so many folks are very slowly dipping their toe back into capital markets activity? When would the right signal be for you? Are you looking west, east, China, the United States? Where is that green flag?
Yeah, this is very much a function of the diamond market specifically more than markets generally. And we've already started to actually see some of these green shoots. Sales of polished goods in December and at the beginning of the year in the US and in India were extremely good, much better than we'd hoped for, actually. So the real issue for us is China and the turn in China's demand for the next green shoot, I think. To signal a real change in the market. The second thing, of course, is currently the midstream for diamonds is really chock-a-block full of inventory, and we'd like to see some of that inventory start to reduce, and our expectation is that that's likely to be in the middle of the year.
Do you see any green shoots, Duncan, in China?
Yeah, I'm cautiously optimistic about China, actually. So there certainly has been some stimulus. The impacts of all of the tariffs has been more muted than anybody suspected that they might be. There is still a real drive for the use of commodities and the application of commodities in the development of China. You're starting to see things like construction starting to improve slightly again. So I am very cautiously optimistic about China. So yeah, some small green shoots there too.
Small green shoots. OK. Duncan, let me ask you about Amplats. We've talked about the restructuring and how that's playing out at De Beers. In the Amplats side of things, you're planning to keep a stake, a pretty sizable, almost 20% stake in the business. What's the rationale for that?
Yeah, look, I mean, it's very important for us to have set Anglo Plats up to be a good, reliable, self-sustaining company going forwards. And within that, we had to come up with an appropriate capital structure. But at the same time, we were looking at our own balance sheet and what we wanted to do with our balance sheet. But the primary driver of the 19.9% stake is to mitigate the impacts of potential flowback of the demerger. So you look at, I mean, these are primary listing will be in a different jurisdiction from where it's currently listed today, Johannesburg versus London. When that happens, there's always inevitably some form of flowback that happens. We have some really good experience of doing this with the likes of Mondi, with the likes of Tungela before, and this was what we thought was the best way to effectively manage the impact of that flowback for all of the shareholders.
So, Duncan, is there a time frame on how you'll dispose of that remaining stake?
Yeah, look, I mean, it's definitely a stake that will be sold. I mean, we need to do it responsibly and at the right time. So it'll be subject to, the usual forms of lockup. But our expectation is that we wouldn't have to hold it for too long.
I just also want to ask you about this warning you've given the OECD about tax authorities ring-fencing your mining earnings from other revenue and how that could affect your economic viability, raise investment risk. Where are you worried about that in particular happening, and how damaging could it be, Duncan?
Yeah, no, I'm not particularly worried about it. I think, in the mining jurisdictions where we operate, we've got relatively stable tax agreements in place and operating, very effectively. So, I really do think that we are reasonably well set up in terms of where we operate from a tax perspective.
All right, Duncan Wanblad, the Anglo-American CEO, joining us this morning after his earnings. We thank you so much for joining the program. As we speak to him, let's get a quick check on the Core 6 as we have those initial pricing now coming out on the heavyweights of the Stock 600. You are seeing Nestle shares down about 0.4%. I'm going to work my way from right to left. Schneider Electric is the main outperformer, higher by a whopping 5% this morning. They actually beat on their estimates. ASML not so lucky in that tech trade, down by 0.5% as well. Ferrari flat, not going anywhere in a hurry. LVMH is also the outperformer, really going against the grain when it comes to perhaps some of the other kind of consumer names that are on the back foot this morning. And, of course, Novo Nordisk in that same vein, lower by 0.2%. Let's get a quick check on some of the other stocks on the move. Joe Easton's all over it. Joe.
So one stock not having a good day in the consumer sector. Kriti is Carrefour over in France. This one is hit on some weakness in some of their convenience stores, particularly in the home market of France. That's where they're seeing a lot of prices coming down, according to analysts. Actually, the Brazil market, one of their other big areas, actually looking pretty strong, but it looks like weakness in French convenience stores is weighing on that stock this morning. Then, in terms of the semiconductors, you mentioned ASML there. I think this is a feed through from BE Semi, absolutely slammed over in Amsterdam this morning. It was down 10% at the open. It was in a volatility hole. It's opened up now. We're down 8% for that one. Weakness on the orders, hybrid bonding in semiconductors. I won't pretend to be an expert on that, but they have seen some weakness, and apparently expectations were very high coming into this. A lot of disappointment on the street for that one this morning. Then in terms of Airbus, missing on deliveries by around 3 planes. We're not going to split hairs over 3 planes, but the stock is weaker on the disappointing dividend, according to analysts at Jefferies today. They say that is underwhelming in terms of the special dividend for Airbus. Continued to outperform Boeing, of course, over the past year, but coming down again today. Then Schneider Electric, that's really the big one. Who knew that this was exposed to AI until a couple of weeks ago when we had the DeepSeek drop? But Schneider coming up today around 6%. Strong orders, as Kriti mentioned. Also, the margins looking pretty strong for that massive French company. More than 100 billion, around 150 billion market cap, by far the biggest points mover today. Then, in terms of Centrica, returning more cash to its shareholders, around 500 million quid will go back to the investors in Centrica. The owner of British Gas had a big boost from all of those higher energy bills, and also they've got a big gas business that's done well as well. So that stock jumping here in London this morning. Then finally, to finish on a morning call, we've got UBS, a downgrade we mentioned earlier. That one is cut at Morgan Stanley today. They reckon that the potential Swiss changes on capital regulation is going to be a negative, potentially going to stymie the dividend and buybacks for UBS. So that one is downgraded at Morgan Stanley, and we're falling 1.4% in Zurich this morning.
Joe, thank you. Joe Easton from our equities team with an update on some of those movers, and there are plenty of them this morning. Coming up, we'll continue the conversation about the mining sector. Profits plunge at Fortescue on soft demand for iron ore from China. Given we've just had a conversation about China and talking about green shoots, Anglo American, we wonder what the CEO of the Australian miner makes of that. Does he see green shoots? We'll get into that with Dino Otranto. That conversation next. This is Bloomberg.
Well, as we look at the likes of Rio and Anglo American up this morning after their earnings, we continue the mining theme. First half profits at Fortescue plunging 53% from the year before on soft demand for iron ore out of China. Now, the company's net income fell to $1.55 billion despite record shipments of iron ore. And we can get into these results now in an exclusive conversation with the CEO of Fortescue, Dino Otranto. Really good to have you with us around the table this morning, Dino. And I want to start on that China theme, because we were just talking to Duncan Van Blad. He says he sees small green shoots there. The BHP CEO, Mike Henry, says there are early signs of a recovery. You've taken a bit of a knock from the China property woes, but are you optimistic looking ahead?
Yeah, we've been in China since we started, more than 20 years, and we take a mid to long-term view, and certainly the fundamentals of China are amazing, really. 5.5% GDP last year on a much, much bigger base. And we're seeing the government really step in to make sure that that property sector is supported, coupled with the diversification that we've seen over the last 5 years into higher-end products, and the automotive industry can speak for itself, and it's consuming a lot of steel. So we're really excited, actually, about China.
But then how do you layer in the tariff story? Because Donald Trump says it will be possible to reach a fresh trade deal with China, but then you've still got the 25% steel tariffs to factor in. So how do you plan around all of that?
Yeah, so we call it Trump version 1, the first time around with China, and we've seen China really respond structurally to diversify around its exposure to the US. So we believe the tariff situation, wherever it may land, it's early days, is not that much of a concern, particularly for our products, which have a high degree of liquidity going into China.
Well, so much of that, it feels like the optimism around China, which you're not the only one out there saying it, even in the mining sector, is tied to that fiscal stimulus from the Chinese government. China's having a moment in the sun right now, the way that Europe is. How sustainable is that? How much how much visibility do you have on that?
Yeah, so the first point I'd make is the 40-year property development cycle has certainly matured. We're seeing that sector reaching a more normal and sustainable level. But what's really surprised everybody since COVID is their commitment to the energy transition. Last year alone, nearly $1 trillion worth of investment went on the ground in China in infrastructure. And again, that is creating a demand for copper, for steel products moving forward. And what we're working on is being part of that energy transition with them, not only providing some of the raw materials for the current transition, but then helping the steel industry itself go green over the next decade. So we see the next chapter of Chinese growth certainly starting to kick off.
So critics would argue the exact kind of positives you're seeing in that market are the very negatives you need to be keeping an eye on, especially because the energy transition is very expensive. So if you're looking at a cost-cutting cycle, those are the very first measures to go. How do you hedge against a thought process like that?
Perfect, and that's really the niche we've been creating. We're embarking, well, halfway through now, an aggressive decarbonisation plan to demonstrate to the world that heavy industrial emitters like us can turn a profit whilst going green. And as we're seeing some of our competitors fall away, we really are that unique value proposition now to show the industry it is possible, and it's possible to do it through sound economics. Here in the UK, we have our Fortescue Zero business, a subsidiary, which is selling those decarbonisation products to the market. It's quite exciting, actually, although a little bit apprehensive as we're working through being somewhat alone or at the sharp end of the spear here.
Yeah, and I wonder how you think a change of personnel at the White House impacts the speed at which you have to live up to those expectations, Dino. I mean, has President Trump's presence and his views, widely reported views on climate change, does that change the narrative in the sector at all about how quickly you have to get to greener targets?
Yeah, sure. I mean, Trump's been quite vocal about his position on gas. I think in time, facts and the reality will come through in the sense that recently we've seen the head of the IEA report about the electricity consumption will be 6 times faster than the total energy demand over the next decade. And we firmly believe that the traditional gas sector will not be able to supply all the physical electrons that the US needs, particularly as AI really takes hold and we're seeing that data centre and hyperscale investment take off. You need a lot of power for that. And the choice will be down to a dirty coal-fired power station or actually a cheaper source of solar voltaics that's readily available now.
Okay. So that's the energy transition and how it still is in focus, certainly with data centres and the like. We talked a little bit about your relationship with China, and that seems to be a big area of focus for you. But President Trump also talking about tariffs on aluminium and on steel, and Australia reportedly hoping for some kind of carve-out from that. Is the Australian mining sector in general confident that Australia gets these carve-outs on tariffs?
Yeah, sure. So we have quite a mature free trade agreement as Australia with the US that's been successfully negotiated in the last 5 years, and Trump has already started to acknowledge that with our Prime Minister engaging with Trump quite recently. Most of the iron ore that we sell out of the Pilbara region does go into China. They have 1 billion tonnes out of the 1.6 globally. You're seeing India, you're seeing Europe starting to come up. So I believe we're well positioned to weather this headwind around tariffs, but I think it's also early days. We don't really understand what that environment, again, macro across the industry, or will it be country to country specific, will play out.
OK, thank you so much, Dino, for coming to see us whilst you're in London. Thank you for coming by the studio. The Fortescue CEO, Dino Otranto. That sets us up nicely for our next conversation, where we're going to talk about energy, but here in Europe. Germany's Conservatives and Social Democrat parties have pledged to reduce energy prices, which is a key issue for many voters in Germany. Details are a little bit sketchy, remain light on the details, so we'll continue to ask questions about what the different parties propose when it comes to the energy sector. We'll have a guest to talk about that. That's next. This is Bloomberg.
This is the opening trader. At 30 minutes into today's session, take a look at the green on your screen, because a lot of it is concentrated in the DAX this morning, higher by 0.5%. So that trend that we're seeing, where Europe is having its moment in the sun, a lot of that driven by defense thoughts, as well as perhaps the wind-up into the German election this weekend, certainly showing up in today's trade as well. Where you're not seeing so much of the love is in the FTSE 100, down about 0.2%. That's likely to have a little bit of that mining exposure. I want to take a quick look at the French stocks as well, because we are getting a couple of different lines from the tech read-through, and that's going to be crucial. Schneider Electric having an amazing day today, higher by, we'll call it 6%. I'm going to go ahead and round up there, simply because you're seeing some massive orders create a pretty decent, not only beat to estimates, but good revenue generation and profits there as well. ASML not so lucky, and BE Semiconductor also taking a beating down this morning, about 7.5%. So chips, which used to be kind of the trade du jour, not having that day today.
Yeah, and interesting that basic resources have turned things around and actually the best performing sector now. But still London goes weaker, to your point, Kriti. Energy is one of the reasons for that, and healthcare also under pressure. Let's stick with the energy theme, though, because Germany is set to scale back its efforts to transition to clean fuel, despite having spent billions up to this point in subsidies. This comes as the leading political parties prioritise security and immigration issues over the energy transition. Let us get an update on this angle on the German election. Let's bring in Bloomberg's Oliver Crook, who is in Berlin. Ollie, bring us up to date.
Yeah, so listen, Anna, when we think about the last election back in 2021 and really how well this sort of green agenda had been doing, you remember in 2019, the last time you had EU elections, again, the Greens were extremely well represented in the European Parliament. They were very well represented in German Parliament in 2021 in that election, which is what has led them to be part of the governing coalition of Germany. The Green story in Germany, though, however, over the sort of 3 years of that coalition, that stoplight, traffic light coalition, has really sort of changed in terms of public opinion, right? There was a lot of sort of pushing towards moving towards more green policies. It was this issue of heat pumps, very expensive, was really upsetting to a number of Germans. And there's been a sort of move and a swing away, which is represented in how the Green Party is polling now. They've still held on to, a number. They're still in the double digits, about 13, 14% in the polls. But it is very safe to say that climate and the sort of energy transition, at least as far as the public is concerned, has diminished in terms of priorities. As far as the parties are concerned, the SPD and the CDU have both sort of are sticking to the pledge to find net neutrality in Germany in 2045. The question is really at what pace, and there has been a little bit of doubt sowed by Friedrich Merz and some of the comments he's made about the energy sector. He's talked about basically wind turbines sort of being ugly. He's put a little bit of doubts about sort of green steel targets for German industry. Of course, this is sort of seen as one of the things that sort of hamstrings European industries, this real concern with climate when the rest of the world doesn't, sort of elevating the cost of doing business in Germany. And this is, of course, Anna, something that has been a prominent talking point for the AfD, which is basically called, German sort of energy policy completely crazy. They want to bring back nuclear energy. They want to burn more fossil fuels in order to get that competitiveness up in Germany.
So given it's not a top priority for voters, the energy crisis, Ollie, and given all the pressure to spend more on things like defence, where on earth is the money going to come from to get on with that green transition?
Listen, Lizzie, you asked the right question, and I think that the question for many people in Germany is whether there's going to be a loosening of the debt brake, whether there's going to be loosening of this concept of joint debt at the European level to deal with a number of the concerns that are dealing and facing not only Germany, but Europe as a whole. And I think that what's really very interesting, we haven't heard from Mario Draghi in a little while now. Remember, he put that report out in September, and really the focus of that report was European competitiveness against China. Now we have a Trump administration that is bringing in a whole new dimension to that. And, I think there's a real sort of question now. What is more dangerous to German industry? Is it American industrial policy, or is it Chinese industrial policy? And when you think about sort of energy and AI and all the ways that you're falling behind, we actually heard from Mario Draghi this week. I want to bring you just a soundbite of what he had to say a little bit earlier before European Parliament. Have a listen.
You say no to public debt. You say no to the single market. You say no to create the capital market union. You can't say no to everything. Otherwise, you have also to admit, to be consistent, that you are not able to deliver on the fundamental values for which this European Union has been created. So when you ask me what is best to do now, I say, I have no idea, but do something.
Do something. That is the message from the former ECB president Mario Draghi, and again, just sort of emphasizing that the sort of competitiveness question before the European countries has not diminished at all since he put out that report in September. It has only augmented. And again, we think about what are the levers that these European countries can pull. We talk about this question of joint debt. I think that this is an unavoidable conversation going forward in Brussels. No one is still sort of on board from the more sort of fiscally hawkish side, whether it's the Germans, whether it's the Dutch. But listen, at a certain point, there is huge sort of fiscal strain across the European system if you need to get that defense spending. And again, every single tweet that we get out from Donald Trump is putting more and more doubt about what the sort of U.S. role is and going to be in collective European defense. This is going to be the question before leaders. Can you have this sort of political momentum to do something about it? And is Friedrich Merz the man to try to bring that sort of new era of Europeanness sort of forward in unity? That is going to be the big question.
An unavoidable conversation. Oliver Crook, we thank you. And we're going to continue it now and stick with Germany, the focus on its energy challenges ahead of the election. We can talk to Claudia Kempfert, who's head of the Department of Energy, Transportation and Environment over at the Institute DIW Berlin. Really good to talk to you, Claudia, this morning.
Hello.
Ollie's raised it for us. Good morning. Do any of the candidates in the German election give you the confidence that Germany can stave off an energy crisis?
Well, yeah, I think so. An energy crisis is not in front of us because we had an energy crisis in the past, especially coming from the gas crisis, where Germany stick too long to the Russian gas, and Russia stopped the delivery from gas or of gas to Germany, and that was really a crisis. Now, to the future, they all stick to the energy transition, and I think a conservative party as well. They want to increase also renewable energy, which is good, which could bring also the electricity prices down. But still, Germany relies very much on fossil energy, and fossil energy is quite expensive and brings the energy prices up. So I think a crisis is not in front of us, but there are difficult times, especially in this geopolitical risk times.
Yeah, but, you know, of course, the Conservatives, the Social Democrats promising to cut energy prices, that's what voters care about. But light on the details, how should it be financed?
Yeah, that's a big question. Also, the previous speaker was saying this. I mean, that's a difficult question, whether Germany really stick also to the debt brake, which is difficult. And if they remove it or also reform it a little bit, there might be investment. And investment will come also from the private sector because the industry needs to modernize. They need to invest into digitalization, into energy efficiency, into renewable energy. And this all needs to be done. And I think also the public investment, yes, this is difficult because now also the money needs to come from somewhere and will be spent also to other sectors. But again, Germany needs investment. The economic situation is quite bad. And this is why I think also there will be a reform also on the debt brake, and there will be investment coming also from this. I hope so, I have to say.
Well, Claudia, what is the risk of that? Good morning, it's Kriti. What is the risk then that investment doesn't actually come, given that there are so many domestic factions within Germany that are saying, why don't we just get more energy from Russia and kind of solve our problems that way, especially at a time when it kind of feels like the narrative of a rehabilitation of Russia and the global economy is starting to emerge. Is Germany the front line of that? Is Germany's energy crisis the front line of that?
No, I mean, there are not many voices in asking to get back Russian gas because of the past experience and the gas crisis we were in. And Russia stopped the gas deliveries. And now, in this very difficult geopolitical times, I think this is not really an option to increase or to go back to Russian gas, and also to rebuild somewhere and somehow to the Nord Stream 1 and 2 pipeline, which is even difficult. It's a private pipeline, so that is not an option, I think. However, now in the discussion also with the US, we will see we are getting now, or Germany is getting a lot of LNG gas from the US. Whether this will increase also in these times of deal making in the world, whether this is an option, and Germany will also move forward with the energy transition and bring down the gas demand, especially in the building sector, but also in the electricity sector. And all this, I think, drives also the energy transition. Hopefully, because in the past it was quite difficult with the energy saving, especially in the building sector.
Well, Claudia, one piece of that has also been Germany's relationship on the energy story with the likes of Norway, with the likes of France, really drawing on electricity from other parts of Europe. It's creating a lot of tension. You've seen this in Norwegian politics as one example. How does Germany kind of help generate that and ultimately, ideally, become an energy exporter the way that some of its peers are, rather than a drain on the EU's resources?
Yeah, that's really a difficult question because Germany right now is an importer of energy, especially from Norway. The gas is important. Without that, Germany would struggle a lot. And now with the electricity sector, we will see whether we will increase the renewable energies and also be able to export renewable electricity to other countries, and also sometimes help France when their nuclear power is not in place. But that's really a difficult story. First of all, from the German perspective, they see the energy transition to bring the energy transition in Germany forward with the energy saving in the building sector, but also with the transportation sector, and that's difficult enough. And we will see how far Germany will get also with the new government.
Yes, good morning to you, Claudia. And as Germany, just like many other European countries, listening to the words of Mario Draghi and others, thinks about competitiveness and how Europe increases its competitiveness, it's interesting to look at the cost of energy in Germany. The German power premium over, it's more expensive in Germany than it is in France by the numbers I'm looking at. It also trades more expensively than in the US, than in China and in other places. Is this something that's going to be seriously addressed to try and deliver for business in Germany?
Yeah, all the parties in their election programs name it, and they want to solve it in a way. Some talk about this cap on electricity prices or bring the grid access fees down, which also move down then the electricity price. But also some talk about, from the European level now, about PPAs, the power purchase agreements for renewable energy, or also contracts for difference. And the electricity prices is in focus of all the parties within the election campaign, and they will do it in a way, I'm pretty sure, related to the electricity prices. However, especially the Conservative Party wants to reach the climate neutrality target over CO2 prices, and that would bring up the price for fossil energy to a high level, because then heating costs and also driving costs for consumers will increase, and that contradicts the goal to bring down the energy prices. So there is a little bit of a contradiction also in the programs, and we will see how in the coalition they will agree on a certain measure, but they will address it, I'm pretty sure, because all the parties are talking about it.
Claudia, thank you very much. Claudia Kempfert, the head of the Energy, Transportation and Environment Department at DIW Berlin. We thank you very much for bringing us your perspective. Just days now until the German election, of course. We'll bring you all of the news, analysis and market moves as we continue to build up to that German election. It takes place on Sunday. We'll have a special programme for you when polls close on February 23rd, live from Berlin. Coming up on the programme, we'll be back to the corporate earnings stories. Lloyds, the biggest UK provider of car finance, has set aside an additional £700 million for the possible costs of a regulatory probe into that particular part of their business. We'll get the latest on this long-running story. We will speak to the CEO of Lloyds. That's next. This is Bloomberg.
Welcome back to the opening trade. We're about 46 minutes into today's session. Seeing green on the screen everywhere but the FTSE 100. And this is crucial because you are seeing the stock 600 as a whole higher this morning by about 0.3%. Zoom in on the 50 and you get higher by about 0.1%. The outperformance in the DAX continues to be a theme. But today, Schneider Electric moving the French index a little bit higher. It's one of those massive revenue and profit beat that you're seeing there that's moving the CAC around higher by 0.4%. We'll see if this holds into the close, Anna.
Let's talk about what's going on in the banking sector in the UK. Lloyds Banking Group has reported profits that missed expectations in the fourth quarter. And that's because the bank, the biggest UK provider of car finance, has set aside an additional £700 million for the possible costs of a regulatory probe into the business. Let's speak to Charlie Nunn, CEO of Lloyds Banking Group. A pleasure, Charlie, to have you on the programme once again. Thanks for coming to talk to us. So let me start. I acknowledge the shares are higher this morning, up by 2.3%. So there's more than the car story to talk about today. But if I focus in on the car story, you previously set aside £450 million. Today you're setting aside £700 million. I appreciate there's a lack of clarity perhaps around this. Some analysts talking about a hit for you that could be as high as a few billion. What kind of visibility do you have on this being enough in terms of money set aside?
Yes, morning. Thanks for having me. So as you say, we've just announced a robust set of results for 2024. great underlying growth in the business, strong distributions for shareholders, but it did include this £700 million provision for motor finance, which is off the back of a Court of Appeal decision that was made last October. As you said, look, there's lots of uncertainty at the moment, and this is our best estimate of what we think it will cost. This, along with the £450 million that we set last year. We might be higher or lower ultimately, but the uncertainty is really linked to the next court case. The Supreme Court has had an accelerated timeline, is going to review the Court of Appeal decision. We'll have some insight to that later in this year. They're going to hear that in April, and I think that's the next moment that we'll get insight as to whether we've got this right.
OK, so come April, we'll get a sense of whether you provided enough or whether there's more or you provided too much. Let me ask you about what this is doing to your ability to pitch Lloyds Banking Group internationally. You have a number of shareholders in the United States, Charlie, and globally. And I wonder what the attitude is to investing in bank stocks, because this story, the initial ruling, the government's involvement and then pushback on it has created a huge amount of volatility in your stock and that of others.
Yes, that's right. I mean, the first thing is actually Lloyds Banking Group's share price is up again well this year, and it's progressed last year as well. So despite this, the underlying business is really keeping us healthy and is making us a good investment for our shareholders. But your point about this specific issue, it has created uncertainty in investors. The core theme really is the Court of Appeal came out with a decision that was at odds with 30 years of regulation. And we always said that we really need clarity on this quickly, because it creates an investability problem, not just for UK financial services, but actually the UK more broadly. Which is why we welcomed actually the interventions from the government, our regulators, the Conduct Authority, Financial Conduct Authority, and actually the accelerated timeline for the Supreme Court to look at this decision. And their decision will become available at about the summer or later in Q3 this year. They're hearing the court case in April, but the decision will be available later in the year.
Charlie, it's Kriti in London. I wanted to look at some of your earnings outside of that motor financing as well, because you've also talked about buybacks and increase to the dividend as well, while you're also still exploring cost-cutting measures. Can you just square the two for us here? How sustainable is that return to shareholders? Yeah, so what we announced today was a robust return to shareholders, a 15% increase in our dividend for 2024, a £1.7 billion share buyback. We've distributed £11 billion to our shareholders in the last 3 years. And we've then reconfirmed our strategy through 26. And we're committed to greater than 15% returns on tangible equity and a greater than 200 basis point capital distribution in capital generation in 2026. So we're feeling really good about the underlying business. We've over-delivered on our strategy outcomes through 24. On revenue growth, as you say, on efficiency saves in the business, and also a capital optimization program of work. And we've now really built momentum as we look into 2026. So we're feeling confident about 26 and looking forward to the innovation and growth we're driving for our customers in the next few years. Well, Charlie, I'd like to dive into that efficiency that you talk about. Is there an expectation here on your end of more layoffs, of more branch closures, or are we done with that phase of the strategy? So the £1.2 billion we announced of cost efficiencies we delivered between 2021 and 2024 were a whole range of things. From we demised about 650 legacy applications. We reduced our head office space by about 30%. We've worked with our partners and our supply chains to improve efficiency. Yes, we reduced our cost to serve through our channels in our retail bank by about 30% per customer. So as we brought on more customers, we were able to scale more efficiently, which was a big driver of this. And we've also continued to drive digitization and automation. We increased the number of our customers logging on to Lloyds Banking Group's 22 million digitally active customers by 50%, over 7 billion logons in 2024. And we think that progress enables us to continue to recycle money, talent, and then technology to serve customers and grow. And that's the plan for the next 2 years, accelerate that efficiency and reinvestment in the business.
And Charlie, traders aren't even fully pricing 2 Bank of England rate cuts this year. Lizzy here, by the way. Good morning. When we think about your outlook, how is that going to affect your business going forward, these moves from the Bank of England?
So we've predicted 3 rate cuts for this year. That's 2 more coming, given the rate cut that the MPC announced last month. And then we predict a continued slow decline in the base rate through 2026. That's all built within our numbers. And actually, what we've announced today is an outlook that shows real income momentum in the second half of last year And we're seeing from here good income and earnings momentum through 25 and 26 as we grow the business, as we build the efficiency of the business. And specifically, we made an announcement around our investments in 2022 to try and deliver £1.5 billion of new revenue growth from strategic initiatives by 2026. We've over-delivered by 24. We're 800 million of growth, and we're feeling really good about the 2026 numbers, and we've now upgraded that to we'll deliver more than £1.5 billion of revenue growth. So that's what's giving us an opportunity to look to the future and see the revenue growth in the business.
OK, I was also interested to see that Lloyds is undertaking this audit on the tech skill set of your workforce, your engineers, thousands of them. What is it that you think you're missing in terms of skills in that group?
So look, we're constantly refreshing both the skills and talent, providing opportunities to reskill people, build apprenticeships, and then hire and recruit new talent. Technology and the use of generative AI and AI has been a core skill of Lloyds Banking Group. And we've been investing in some of those new technologies and delivering lots of new innovation for customers. So this is an evergreen topic for us. We're constantly trying to make sure we've got the right talent, we've got the right skills, both internally and through our partners. And we'll continue to be doing that every year as we go forward as well.
Charlie, I was speaking recently to the NatWest CEO, Paul Thwaite, and we had a conversation about bad loans and how any nervousness in the UK economy, any stress, is not showing up in the bad loan story and provisioning. What's the link between your level of provisioning and the wider economy? I know that there are limits to it.
Yeah. So the economy's shown real resilience. Obviously, we know customers, people and businesses have had some challenges in the last few years. But if you look at the underlying activity, actually households and businesses, on average, have increased their resilience over the last 24 months. Last year alone, households' deposits and cash flows increased 6% year on year. So real financial resilience. We announced very low arrears last year, about 10 basis points on our AQR, which was low. That included some releases. But actually, underlying performance is showing real resilience in the economy. And that's why we have a view that actually the economy, despite the sentiment at the moment and despite some of the challenges, has the potential to start growing faster. And we really need to lean into that and get the right partnership with the government to make sure that happens.
Charlie, thank you. Thank you very much for your time. Charlie Nunn, the CEO at Lloyds Banking Group. Kriti, let's get to some other movers this morning.
Yeah, we should mention we're looking at Infineon shares, higher by about 3% this morning. This comes after they won approval for funding under the EU Chips Act to the tune of about €920 million plant that they are looking to build in Dresden, of course, the tech hub of Germany, trying to be kind of the next Silicon Valley of Germany, if you will. This is important simply because this is a state-funded contract. Some of the funding that we're talking about in terms of fiscal investment ahead of the election, the debt break, et cetera, this is all factoring into that. It's interesting that the EU gave a nod to this. It also came from Teresa Ribera, the EU competition chief, who also has a little bit of interest in the climate and energy space as well. AI chips, chip factories take a lot of energy, so we'll see how this all shakes out. OK, we'll watch that one. That share price, as you say, higher this morning. Also of interest, we should tell you that coming up on programming, a conversation with the US Treasury Secretary, Scott Bessent. That is at midday, London time. No doubt a lot of focus on the United States, but also perhaps on Ukraine. He's just come back from a trip there. What was the intention of that around mineral access for America into Ukraine? How important is that in a settlement for Ukraine, or a settled future for Ukraine? That is it for the opening trade. The Pulse is next. This is Bloomberg.